Welcome to the show. Well, M&M's numbers are just flashing for you on the screen, and these numbers are actually better than what the street was estimating on both the top line as well as on the EBITDA front. Even the margins are higher than street estimates. And if you remember, the big focus area for M&M really was the auto segment. The SUV growth has been very strong, and that is pretty much what's leading to a good growth on the top line as well. So margins at 12.4%. If you compare the margins over the last 3 quarters, the margins have stayed above this 12% mark. So in Q2, it was 12.6%. In Q3, 12.8%, and in Q4, 12.4%. So 3 quarters of consistently 12% plus margins is what we're seeing for M&M. Remember, the stock has priced a lot of this in. It has been sitting at a fresh record high as well, and hence there's just a marginal up move, in the stock at this point in time. But very strong numbers on the top line. If you look at it, it's about I think 8% growth that we're seeing on the top line, better than street estimates for sure. And the EBITDA growth as well has come in better than estimated. The profit number, we should just wait for that to come up on your screen. Okay, 11.5% growth is what we're seeing on the top line, better than street estimates. Now, this time, as I said, it has been a double-digit growth on the auto segment. The auto segment volumes were up about 13%. But it is the commentary on the tractor segment that, we are awaiting from the management, because that has been the weak pocket. The tractor segment volumes were down about 20-odd%. Abhishek Gaoshinde is joining in. He's the Deputy Vice President of Research at Sharekhan by BNP Paribas. Abhishek, thanks a lot for joining in. These look like a strong set of numbers coming in from the management, at least better than our expectations. Double-digit revenue growth is what we've seen. Margins have been above 12% for the third consecutive quarter now. Your thoughts on the earnings, and do you see further upsides in the stock given the kind of run-up that we've already seen?
Basically, you rightly said that the numbers were slightly above our estimates, given that in this quarter, the tractor segment performance was very big. So, larger part of this performance is assumed to come from the 2 segments. One is that the automotive segment has performed better, and second, that despite the negative operating leverage, the company has been maybe benefited due to the reduction in this advertisements and promotional expenses, given that in previous quarters there was a 60-70 bps kind of impact in EBIT margin in tractor segment due to the higher advertisement expenses. So in that per se, I think that numbers are slightly slightly better than the estimates, and going forward that the performance we assume would be largely driven by the automotive segment only, given that this tractor industry is likely to face headwinds or register a moderation in its growth trend.
Okay, there's some more details actually coming through in the press release. So the tractor sector, right, as we've been telling you, has been under a bit of pressure. The company has actually lost market share in the tractor segment. So their tractor market share has come in at 39.4%, which is down 130 basis points. They've said it's down 130 basis points. I reckon it is a year-on-year drop that we're seeing in the tractor segment market share. And they even speak about how the overall consolidated Q4 revenues in the farm equipment segment are down 22%, and that's for the quarter. And for the full year, the farm equipment segment is down 2%. So how would you read into this, the fact that, tractors have not only slowed down, but they have also lost market share in this space, down 130 basis points. Do you think that could put a lid on the stock gains in the near term?
Largely, it was known in the street that given that in previous quarter, the company was focusing more on the inventory control due to the shift in a festive season from March to April. And second thing is that the overall tractor industry is facing headwinds in the southern and the western market, especially in the higher HP segment. So that has been the reflection of the market share loss is a reflection of that thing only. I don't think that would be a major concern, given that the company has a strong dominant position in almost all of the markets and has a strong financial arm to support its its tractor sales. So market share gain may come in the coming quarters, but the growth part that we are expecting would be seen more in the automotive segment compared to the tractor segment. We are expecting that the tractor segment's margin, it will continue to retain or sustain a higher margin trajectory in the tractor segment and gradually improve its margin in the automotive segment, and that will drive its performance going forward.
So the automotive margins have actually improved. Year on year, if you look at it, automotive margins, PBIT percentage has come in at 8.8% versus 7.1% same time last year. But the farm equipment, which is the tractor segment, margins have fallen year on year to 15.8% versus 16.4%. So as you were rightly pointing out, Abhishek, automotive margins have actually improved both year on year and quarter on quarter. So at this price, at 2,300, is the risk reward still favorable for a long-term investor?
See, structural growth story will be continued with the Mahindra & Mahindra, but yes, we have seen a sharp run-up in the past few months, or we can say on a YTD basis, stock has run up by 30%. But there have been a substantial reason for that. Historically, the performance was dependent completely on the tractor segment, and the street was looking it for the tractor player only. But now, when this PV segment is improving both in its volume performance and this margin performance, then I think street would be ready to give it some more time to play on this story. One thing I would like to hear is that I would like to highlight here is that historically the the tractors segment share in the EBIT was almost 60%, but now for last 2-3 quarters the share of automotive segment in the EBIT has been improving, and given that the kind of order book it has been gaining and the capacity is coming out, and the kind of guidance most of the players are giving from the PV segment, we may see the company may outperform the PV industry growth in FY25. So that would add value for Mahindra & Mahindra going forward.
Okay, all right. Thanks a lot, Abhishek, for your thoughts here. In case you joined in late, then the M&M numbers have just come out. The earnings are above street estimates. The revenue growth has come in at 11.5% at 25,109 crores. The margins as well at 12.4% are better than street estimates. But the stock, remember, has had a very strong run. And if you look at the internals, you'll realize that the tractor business continues to be under pressure. In fact, the company has lost market share in the tractor space, and that could be the reason why the stock is under a little bit of pressure. The tractor market share in Q4 has fallen to 39.4%, which is down 130 basis points year on year. That's all the time we have. Let's move back to our mutual fund corner.